Good evening and welcome to Wednesday night, Your Money, Your Call. I'm Chris Kimber. Joining me tonight is Roger Montgomery from rogermontgomery.com. Mr. Bernanke that was in Brisbane today. Roger, it's actually Glenn Stevens. It's actually Glenn Stevens giving a speech, which probably makes it. Now, he seemed to indicate today that we're still looking at another rate rise in August.
Yeah, well, look, I don't worry too much about individual interest rate changes. If you're buying businesses that should either win market share or maintain or increase their competitive advantage irrespective of the economic conditions. Now, the truth of the matter is that irrespective, if the economy does badly, then stocks are going to do badly in anticipation of that. If the economy does well, stocks should do well in anticipation of that. What's interesting is the US situation where we've got really low interest rates. Now, that's supposed to encourage economic growth. I think it does the exact opposite. Right. I think it's very unusual, but an unusual thought. But here's a suggestion for you: if interest rates are very, very low, rather than encouraging people to spend, it causes cash to flow out of an economy and to look for better interest rates elsewhere and better investment returns elsewhere. And so, much like Japan. For many, many years they've been in the doldrums and they had very, very low interest rates, but what they saw was cash flowing out of their economy, and that's now going to happen in the United States.
Yeah. Okay, well, we've seen the weakness in the dollar, so you think it's going to stay the same way? They're going to keep the foot to the pedal, keep the dollar low? Well,
look, I think they will. I think right now we'll probably see a period where the dollar actually strengthens, because I think the tables have turned and there's a lot of negativity towards Europe at the moment. Okay. So we'll see a dollar bounce, but ultimately structurally it's got major issues.
All right, thanks. Somebody who wasn't shy today was Graham Hart, New Zealand billionaire, who stepped up to the plate and bid $1.6 billion for a US listed stock. Graham Packaging, seeking to increase his empire. Now, Roger, we were talking about Amcor. I know it's probably a stock that hasn't been in your portfolio, but I know we've had other people that like it. Anything about what Mr. Hart's doing, or that sector, or Amcor?
Look, what is typically going to happen in these situations is that investors will compare the premium that Graham Hart pays for the business that he buys to the premium that's available for Amcor in Australia, and say, well, this looks cheap. Its multiple is lower than that multiple, therefore it should be more expensive. But you've got to remember the quality of the business matters as well, and Amcor is a business whose intrinsic value hasn't increased in 10 years, and that's partly because its performance has been so poor. Yeah. Now that may change, and even if it does, even if the intrinsic value of the business improves, it's improving from such a low base that the share price is still expensive compared to what I think the intrinsic value of this business is going forward.
I think that's fair enough. Our callers, we've got Rob waiting on the line from Melbourne. Hi Rob, what's your question for us tonight?
Yeah, g'day Chris and hi panel. I'm just after more of a technical on Menco Holdings, which is EHL. I bought them just for a short-term trade, 3 to 6 months. Yep. Yeah, just the panel's thoughts, thanks.
Okay, listen, thanks very much, Rob. Unfortunately, we're not going to be able to help you out with technical view tonight. I think we're pretty sure we've got all sort of fundamental guys here. Yes. But look, Menco, EHL, look, I'm not sure how that stock's been going. It hasn't been in my portfolio, Roger.
Well, look, I can tell you that the intrinsic value of this business for this year, for 2011, I've got an estimate of about 65 cents. In 2007, it was 70 cents. Yes. So there's been no change. And perhaps unsurprisingly, as a result of that, the share price today is about $1.09 or $1.10. And back in 2007, it was $1.84. Yeah. So, there's been a net decline in the price, and that's reflected a net decline in the intrinsic value over that period of time. Now, the intrinsic value, the estimates, the expectations for this business are that its intrinsic value is going to improve. But the reality is that even if it does, the share price is anticipating that. It's expensive at the moment.
Okay, I think that's fair. Go straight to Mark from the Sunshine Coast. Hi, Mark. What's your question for us?
Evening, folks. I wanted a fundamental on McMillan and Shakespeare. Yep. And if you guys could all give us one mid-cap stock that you think might do all right in the next 6 months to year.
No trouble. Listen, thanks very much. Roger, McMillan Shakespeare, I think that's probably one of the value plays out there. I mean, I think we've discussed it before on Your Money, Your Call.
Well, it was a value play when its share price was lower.
Right, yep.
Its share price is still expensive, despite the fact that it's sold off recently. It's come back from $10.60 or thereabouts. It's come all the way back to, it's dropped about $1. But my intrinsic value for this business is $8.14 for 2012. So it's still expensive for me. Very high quality business, really like the business, just expensive.
Do you want to throw in a new mid-cap or anything that you're particularly watching at the moment?
How about we wait and see if anyone asks during
and
the night, and then I'll tell you if
I thought you might say that. Okay.
Yeah, exactly.
But Roger, Medusa, what's your value look like on that?
It's trading right on its intrinsic value at the moment. I do own one gold stock, and it caused a bit of a flurry of interest when I said that I own one gold stock. Everyone wanted to know what it is. I've already said publicly that I will buy it, own it and sell it without ever disclosing what it was. But I do own one. It's not this one.
You can tell us if you made or lost money though, can't you?
I've made money.
Okay,
don't worry about that. I did read some research. This week actually from a guy who's been rated, a guy in the US. He's been rated the #1 market timer from 2006 to 2011 or 2010.
That'll all depend on where you did those dates.
And rated by Bloomberg and rated by a whole bunch of people as sort of the best. And he's saying that the gold could actually go well over $5,000 an ounce.
Oh, wow.
And he thinks right now, look, I don't know whether that's right or not.
Yeah.
When?
Well, I don't think he said
next
when.
Wednesday.
At 4:30. You'll be in transit having left the office, so you'll miss it. So it's just interesting. So his view was that gold is consolidating at the moment, and it will continue to go up at some point. Whatever that is, I don't know. He didn't know either. But that's his target for the gold price. At some point there'll be this almighty rally, and it'll be a massive bubble. And Soros, I think he made the point that Soros sold early.
Yeah, well, but Soros sold gold and bought stocks though, which I think sort of fooled everybody there for a little while. They thought he was getting out. He was just changing his exposure.
And Jim Chanos does the same thing. People think he's short China. Well, he's actually long the index. He just sells individual companies around that.
Yeah, it's hard to understand what some of those boys are doing.
Yeah, they're just trying to capture alpha.
Nick, sneak a quick email in right now, and this one's from Andrew from Melbourne. He writes to us, can each of you learned gentlemen, he mustn't have known who was on tonight, please give your view on Bendigo and Adelaide Bank. How do you rate it as a business, and what is its intrinsic value? Well, they must have known Roger was on. Also, are any of the banks good value right now? Thank you very much for your email. Roger?
We own ANZ Bank in our fund.
Right.
Out of all the banks, we think it's the cheapest.
Yep.
We don't think it's the best performing business. We think the Commonwealth Bank is the best performing, and just recently it's come into a discount to its intrinsic value. In terms of Bendigo Adelaide Bank, trading about 8.56. Well, my value for 2012 is 8.53.
Oh,
and my 2013 valuation is $9.11.
Right.
So it's trading right on. There's not much of a discount. There'll always be that. You know, the switching. Their competitive advantage, the oligopoly, the competitive advantage of the banking oligopoly in Australia is very high switching costs. So the perceived benefit from switching is not nearly as great as the cost of doing so. You think about changing your bank, if you run a business particularly, all the accounts and passwords and PIN numbers and everything that you'd have to change. It's just a nightmare doing that. And so the banks do have the power to be able to charge pretty much what they like. Now, just to Michael's point about the NAB, their strategy recently has been a very good one. They've had the smallest share of the mortgage market, so they've got the least to lose from cutting costs on their mortgage style products. What did they do? They cut costs on their mortgage style products, and so people are switching, and that's gaining them some market share points, and that's benefiting them. But ultimately, it is a very simple game. You know, you've got the doors closed, you've got the windows closed, you've got 4 blokes in a room, each with a hand of cards. And one quarter one guy's got a better hand, and another's got better hand.
Fair enough. Thanks for that, boys. Listen, thanks for holding on for us. What's your question for us tonight?
Yeah, mate, I've just got 2 questions. First one's, my stockbroker said if you're looking for a high-risk share that could come good, Neptune Marine Services. Said they're in the right industry. And also,
Roger, I'm pretty sure Neptune might look pretty damaged on your radar there.
Yeah, it's not one of the, I'm just looking at it now, not one of the businesses that I would regard it as investment grade. If it does meet all the expectations that there are on it, then it might be worth 7 or 8 cents. But that's prior to the capital raising and any dilution from that. It's a B4, so for me it's just not investment grade. Fair
enough. And any comments on Mr. Stevens? We've probably already had that conversation.
I've been to lots of dinners with Glenn, and I actually think he's quite brilliant.
Okay, I think that's fair.